The economic landscape in the United States is currently under intense scrutiny as the Federal Reserve continues its delicate balancing act in the fight against inflation. Recent data reveals modest improvements, yet the road to economic stability remains fraught with uncertainty. Federal Reserve Chair Jerome Powell emphasizes a data-driven approach, highlighting the risks of premature or delayed policy adjustments. With the Federal Reserve maintaining interest rates and hinting at potential cuts by year-end, the fluctuating mortgage rates and surprising inflation dips are critical indicators of the complex dynamics at play. As we navigate these economic waters, one question lingers: are we on the path to sustainable economic recovery, or is more turbulence ahead? U.S. Economy News Today: Federal Reserve observes modest gains in inflation battle. Welcome to Investopedia's Economics Live blog, your go-to source for understanding the current state of the U.S. economy and its implications for your finances. We bring you the latest data releases, economic reports, expert insights, and more to help you navigate through the complexities of economic news. Today, economic analysts have a busy agenda with May's inflation figures released this morning and the Federal Reserve's policy decision set for this afternoon. These developments are crucial for assessing the trajectory of the U.S. economy and its potential impact on various financial sectors. Federal Reserve Chair Jerome Powell's perspective. Federal Reserve Chair Jerome Powell reaffirmed that the Policy Setting Committee remains committed to a data-driven approach for making interest rate decisions. Powell reiterated that officials are closely monitoring economic indicators and associated risks to guide their actions. His remarks, consistent with his statements since the year's start, underscore the cautious stance of the Federal Reserve. Our goals have moved towards a better balance, but the economic outlook remains uncertain, Powell stated. We are highly attentive to inflation risks. We do not expect it to be appropriate to reduce the target range for the federal funds rate until we have greater confidence that inflation is moving sustainably towards 2%. Powell further explained, reducing policy restraint too soon or too much could reverse the progress we've seen on inflation. Conversely, reducing it too late or too little could excessively weaken economic activity and employment. Federal Reserve Statement on Inflation. The Federal Reserve's statement this month remained largely unchanged, reinforcing their commitment to relying on data for making rate cut decisions. Inflation has eased over the past year, but remains elevated, the committee noted in their official statement. In recent months, there has been modest further progress towards the committee's 2% inflation objective. This language mirrored the statement from the Fed's May meeting, with a minor change from a lack of further progress to modest. Interest rates and future projections. The Federal Open Market Committee, FOMC, the central bank's policy committee, announced on Wednesday that it would maintain the influential interest rate in a range of 5.25% to 5.5%. This range has been in place since last July, following a rapid series of rate increases from near zero, starting in March 2022. This decision was well anticipated by financial markets, having been signaled by Fed officials in advance. Additionally, Fed officials projected one rate cut by the end of the year, down from 3 in their previous quarterly projections made in March. Mortgage applications surge as rates dip. Data from the Mortgage Bankers Association, MBA, indicated a significant increase in mortgage applications for the week ending June 7, following a slow Memorial Day holiday week. A dip in mortgage rates spurred this surge in refinance activity. The association's index revealed that all mortgage applications rose by 15.6%, with refinancing jumping 28% and purchases increasing by 9%. The average interest rate on a 30-year fixed mortgage dropped to 7.2%, according to the MBA's calculations. Lower rates earlier in the week led to a strong increase in refinance activity, especially for VIA borrowers who seized the opportunity to lower their rates, said MBA's chief economist, Mike Fratantuni. May inflation surprises with decline. In May, inflation decreased faster than many forecasters had predicted. The Consumer Price Index, CPI, showed that prices were virtually unchanged in May, down from a 0.3% increase in April, according to the Bureau of Labor Statistics. Over the year, prices rose by 3.3%, slightly lower than the year-over-year rate in April. Both figures were better than the consensus expectation from economists surveyed by the Dow Jones Newswires and the Wall Street Journal. This report may help alleviate fears of inflation flaring up again after unexpected price increases in the first quarter. Instead, prices have continued their descent, falling significantly from the 41-year peak reached in June 2022, when the CPI was up 9.1% over the previous 12 months. Federal Reserve officials who are meeting later today have stated that they are looking for economic data, especially inflation reports, to show that consumer prices are firmly on the path down to 2% annually before they will consider cutting interest rates. The central bank has maintained its key Fed funds rate at a 23-year high since last July, increasing borrowing costs for mortgages and other loans to slow the economy and curb inflation. Before the report, traders were pricing in an 8.9% chance of a rate cut in July and 54.4% in September, according to the CME Group's FedWatch tool, which forecasts rate movements based on Fed funds futures trading data. Immediately after the data was released, those numbers jumped to 13.9% and 56.9% respectively. As we dissect the latest economic data and Federal Reserve decisions, the journey towards stabilizing the U.S. economy remains complex and uncertain. The modest improvements in inflation and the cautious stance on interest rates highlight the delicate balance policymakers must maintain. As mortgage rates fluctuate and inflation trends defy expectations, one crucial question remains: are we inching closer to a stable economic future, or is the journey fraught with more challenges ahead? Share your thoughts on how these economic dynamics might shape our collective financial well-being.